Today we are with Alan C. Benello, the author of Concentrated Investing, Strategies of the World's Greatest Concentrated Value Investors. Welcome to Redera.
Thank you. It's a pleasure to be here.
Concentrated Investing is a fascinating book. We are always told to diversify. Financial markets are fragile, the markets are inherently volatile, and what we have been always told is that if you diversify, you have a better or more stable returns, and reality is far from that. But tell us how the book came about.
Well, on the subject of diversifying that you were just talking about, it's true that if you diversify, you'll have returns that are more similar to the returns of the broad market indexes. But those returns, the returns of broad market indexes are not always without volatility. There can be plenty of volatility in the index returns as well. So it seems to me that volatility is something you just have to live with if you're going to be an equity investor. And the idea of concentration is that you're not really looking for the returns of the broad market indexes. You're actually looking to create wealth from investing. And it's kind of like aiming at two different targets. If you diversify a lot, you're really aiming at the target of having returns that are similar to the index. But if you're investing to try to create wealth over a long period of time in excess of the market return, then the best way to do that is by having a concentrated portfolio. And we discuss why that's so in the book. And as for the origin of the book, the idea came to me mainly from observation. I became acquainted with a couple of characters in the book in the 1990s when I was working at an investment management firm, and they were people that I admired a great deal, and I noticed that they had a similar approach to portfolio management or portfolio construction, which was basically that they didn't own that many securities. And that really sticks out in the world of investing. Most investment managers have a lot of securities, and these people that I admired a lot and looked up to had much smaller portfolios. And so it got me thinking that there must be something unique and interesting behind what their method was. And the idea for the book also came about because I was riding in a taxi at one point with Michael Van Biema, and we were talking about the fact that there are some really, really highly intelligent people in the investment business who seem to have results that are more kind of mediocre, and there are some people in the investment management business that you run into who don't seem like they're outstandingly intelligent or insightful analysts, and they have returns that are quite respectable and quite good. And so we were wondering what the factors were behind that, if it was more than just kind of random luck. And we came upon the idea that concentration probably has something to do with that. So we decided to investigate it further.
A fascinating topic and very useful insight for most investors. Generally, the investment business is associated with people who are intelligent, very smart, very analytical. But that alone is not enough, as you bring it up in the book, that performance equals generally holding the right amount of stocks or finding the right stock, having the right amount of stock, and then holding it for the right period. How did you realize that was the issue? Because it takes a great deal of experience to really come to that conclusion.
Right. It seemed like the question of portfolio construction was the X factor that was missing in looking at a lot of different managers' performance records over a longer period of time and trying to figure out why the ones that were really outstanding had superior results, as opposed to people whose results were kind of maybe sort of towards the top of the pack, but definitely in the pack and not quite as outstanding.
The paradox of security analysis and portfolio construction is allocation of the capital and building a portfolio and managing the return at the portfolio level is in the long term far more important than investigating and using all your resources and finding that one stock that will beat the market.
The way I would state it is that I think you have to have the ability to understand companies and to do fundamental analysis and really have an idea of where a company is going to be in 5 years or 10 years. But you also have to have the temperament to be able to allocate your the capital that's available to you in such a way that you really profit from those instances where you can have a valuable insight and where you can spot a company that's mispriced by the market and take advantage of it so that you make significant profits from it.
Mm-hmm, mm-hmm. You have in the book highlighted several well-known and very successful investors. Are there any few common themes that you could summarize for our listeners?
I guess one of the themes is that they really don't invest by committee. In fact, they really seem to do the opposite. They all have very, very small operations in terms of the number of people and the number of staff in their offices. I would say that they all tend to be not very marketing oriented in terms of asset gathering oriented. They tend to be much more focused on the investment process and the research process than they are on building up a big investment management business. And that's actually a very important point, because if you're looking to build up a large investment management business, it really behooves you to have quite a bit of diversification. And the reason is that if you're looking to build up a large investment management business with a lot of clients and a lot of client assets, you want to do everything that you can to avoid giving your clients a reason to fire you. And the way to do that is to never have years where your performance is significantly below that of the markets, that of the broad market indexes. So now if you're a concentrated investor, then by definition, you are going to have periods of time where the performance of the funds that you're managing is, way out of sync with what's going on in the broad market indexes. And there are inevitably going to be years when the performance is way below the market. And that's a time when, if you have fickle clients, that they're going to pull their money away and your business is going to suffer. So it would be very difficult to build up a large investment management business, having a very concentrated investment style. So I think one of the factors that the investors that we interview in the book share in common is that they have, by and large, permanent capital, or at least very, very long-term capital. So concentrated investing is not really a great strategy for the typical mutual fund.
Exactly. In the book with 9 chapters, you have highlighted 9 very successful and prominent investors. Would you like to bring out a couple or few of those so that way we can go a little bit more deeper into it? Maybe we can talk a little bit about one that really kind of caught my eye and is not very well known but very successful is the Grinnell College example.
Yes, Grinnell College has had a really, really fantastic track record at investing in the school's endowment, and it's made a huge difference to the college because they're able to offer financial aid to a lot of the student population, much more so than other small liberal arts colleges. And it means that they can have much more diversity in the student body, and which is a real benefit, of course. I guess that the reason that Grinnell College's endowment benefited from this concentrated investing strategy was really due to the involvement of Warren Buffett from an early time.
And with very little trading and mostly investing for the long term, that college in Iowa was managed to turn the portfolio of less than around $15 million to over $1 billion now.
Yeah. And I think that there were some occasions where the college's endowment made investments that right after the purchase of the investment, the share price declined. And rather than being forced to sell the security and take a loss because it was too stressful or too embarrassing, they were able to hold on to these positions that turned out to be huge winners later on. And I think that in many cases, people get scared out of positions if they start performing badly, and that can be a real mistake. And I think one of the keys to Grinnell's success is that they were able to, as is the case with any investor who has access to permanent capital and who is not managing by committee, they were able to hold on to positions that were sometimes performing badly or performing out of sync with the market, and which allowed them to realize very significant gains over a longer period of time that they would not have been able to realize unless they had that freedom.
I think one of the very wise and profitable decisions that was made early on at Grinnell College was to stay away from the U.S. Treasuries and go head on with the U.S. equities or equities in general. And that had a major impact over 30 years.
Exactly. So Grinnell College took the attitude that they were not going to invest in fixed income securities to generate interest income from the endowment. And instead they looked at the total return of the endowment, and then they decided, what percentage of the endowment they were going to take each year to fund the college's operations. So they invested basically zero into fixed income securities and basically 100% into equity securities. And then each year they would liquidate 2% or 3% or whatever it was of the portfolio to take as funds for the college. And as opposed to many endowments which have a portion of their funds available invested in equity securities, which is for growth, and then the rest of the endowment is invested in fixed income securities or in securities that produce regular income, and then use that to fund operations. And Grinnell took a different approach, and it works much better. The other thing that's interesting about Grinnell College is that they used, they basically had zero operating expenses for the endowment, and the main people that were managing the endowment took no compensation, and they also had no overhead in terms of accountants and auditors and administrative people and lawyers. Yeah, it was all done. It was all done on essentially zero cost basis, and those costs are huge over the years.
They add up, and that money was reinvested to generate even more returns. So that's pretty impressive.
Exactly. I mean, yeah, even a 0.25% drag from administrative fees over the years adds up and is a huge dollar amount over the years. Yeah. Yeah. Another investor in the book that we highlight is Christian Siem, who has been basically unknown in the U.S. as an investor. He's known in Europe as a businessman, kind of an industrialist, but he's never really been analyzed as from the point of view of an investor. And if you think about his holding company really as an investment company, closed-end mutual fund or something like that, then the type of investing that he does is very much in sync with the type of concentrated investing that some of the other people in our book do.
Stepping back a little bit, if you would give a little bit of a philosophical backdrop in what is concentrated investing and how concentration is helpful.
Concentrated investing, the idea is that if you really want to create wealth through investing, that it's best to have 5, 10, 15, 20 securities, but not more than that. Optimally, I think about 10 to 15 securities. Look, investing in the broad market indexes over time is a perfectly legitimate strategy. The broad market indexes have a very, very long-term return. I think I'm not sure what it is these days, but it's in the range of 5 to 7%. Maybe it's 6 to 7%. And that's a very good return to be earning over many decades. But if you're aiming to earn in excess of the market returns, then the best way to do that is to have a concentrated portfolio. And we refer to a study that was done at the Santa Fe Institute that kind of explores the effect of concentration on portfolio returns. And it's very intuitive and easy to understand. Basically, the idea is if you take the 500 securities that are in the Standard & Poor's 500 index and you randomly select a group of, say, 10 securities, well, the performance of those 10 securities is going to be very different from the return of the 500 securities. And it will be plus and minus some degree over or below the index. But the chances of it being really similar to the index are pretty small. Whereas if you select 500 securities from an index of 500 securities, the results are obviously going to be pretty much exactly the same. So if you're looking to have results that are different from the index, then it's pretty key to have a smaller portfolio. And then the idea is that if you apply some useful analysis and to fundamental research to stock picking, that you can skew the results so that instead of being on the negative side of the index, have a better chance of being on the positive. And instead of being 10% below, they can have a better chance of being 10% above the index's return.
You highlight in the very way in the book, in one of the chapters that is devoted to John Maynard Keynes, the famous philosopher and economist. He made the fortunes and lost the fortunes, and he became a better investor. Would you summarize and draw upon his experience that how he gravitated without realizing that Graham was also doing the same thing in New York at the same time, focusing on more fundamental investing?
Yeah, John Maynard Keynes appears to be kind of the first really concentrated investor that we could find. And I thought it was interesting to look into his career as an investor, because he's really known as a brilliant economist and less recognized as an investor. And when we looked into his career as an investor and as a concentrated investor, what we found was that he didn't start off that way. He came to it after making some mistakes earlier on in his career, and he had two different hedge funds that invested in commodities and used quite a bit of leverage that both went bust and cost him, considerable headaches, and cost his family and investors considerable headaches also. And I always thought it was very interesting that after having two hedge funds that went bust, he was still, in spite of that, those failures, he was still hired by Cambridge University, by Keynes College, I guess, to manage their endowment. And I can't really think of any university these days that would hire a endowment manager who had previously blown up two different hedge funds. That would be a real leap of faith. But I guess because he was John Maynard Keynes, he was still in the running for endowment managers even after those experiences. But he did end up being a classic concentrated investor, and he really followed companies that he knew very, very closely, and he didn't do much trading. He did a little bit of trading around core positions, but we're talking about a few trades a year. And his performance as a concentrated investor without using leverage was really, really fantastic, and outperformed the London Stock Exchange by more than 10 percentage points over a long, long period of time.
Oftentimes, investors have lots of intelligence available to them, and many of them are also very resourceful. But what they lack is the temperament Can you go a little bit deeper into, based on your reading and researching and meeting successful investors, or how people can develop that temperament, or they are either born with it, or they just don't have it?
I have to apologize. I don't know that I can really delve into that subject more because it's a little bit mysterious to me. I'm not sure if people have to be born with it or whether they can develop it. I mean, our minds are very plastic and very flexible, and I tend to think that we have a lot of ability to affect our temperament and our outlook on life if we reflect on it. But what exactly it means to have the temperament of a concentrated value investor, it's a little bit of a mystery to me. I think one factor is that you have to be oriented in the direction of wanting to build wealth from investing in securities markets, as opposed to being oriented towards tracking the indexes or having returns that are close to the indexes. And that gets back to the point of, is your aim to build a large investment management business or a large asset gathering business that produces a handsome fee income annually, or is your aim to really increase the assets that you have under management by earning high returns? Is it a return-driven business, or is it a asset gathering business? So that's one main focus. And if you're oriented towards earning high returns, like you would be with an endowment or with some kind of permanent capital setup like Christian Siem has, then you really don't have to expend energy and in the direction of worrying about what clients are going to say and what kind of marketing budget you should have and what kind of advertising you should be doing. That makes a lot of space for doing investing as opposed to running the more mundane aspects of the business.
Charlie Munger was an equally successful investor like his partner Warren Buffett, but his thinking and his process is not very well, at least talked about in the media, at least until recent years. He is someone more focused on the quality without compromising at all. Tell us how he managed to deliver or build such a good track record of returns.
Well, he came to the idea of concentration his own, and he, as you said, focused on higher quality businesses rather than on special situations and cigar butt type investing. And it is true that his investment partnership had some volatility, as to use the jargon of the day. Volatility is another word for drawdowns, I guess. But in spite of even with the volatility that he experienced, and I guess it was 73, 74, the returns for his partnership were really, really outstanding. And, I think that's a great lesson about concentrated investing, is that you have to be willing to withstand periods of volatility, but the long-term result can be really superior even with that kind of volatility. In the book, I think we talk about Lew Simpson's track record. There was a period of a couple of years where Lew Simpson underperformed the S&P 500 by 49% cumulatively, I believe. And in spite of that underperformance, which is pretty dramatic, he had a really, really fantastic long-term record. If you think about it, that kind of underperformance is real career risk for an investment manager. So again, it points to the fact that you really have to have stable capital to invest if you're going to be undertaking a concentrated approach.
The stable capital, a permanent capital, and those are the things that will allow you to focus on the absolute return rather than beating the index on a quarter or a year basis.
Right. That's exactly right. That's very well put. We were speaking before about Charlie Munger and the fact that he gravitated towards higher quality businesses. And I think Christian Siem, there was a period in his life when he was really only focused on oil rigs, offshore, ocean-going oil rigs.
In Norway.
And, well, I guess he was investing worldwide in oil rigs. But I think the takeaway from that is that whether you're investing in higher quality companies that are publicly traded in the U.S. or whether you're investing in cigar butt situations in emerging markets or whether you're investing in oil rigs, the asset that you're investing in is less important. And what's more important is that you have a concentrated investment style and a value-oriented approach, that you're doing, fundamental analysis and that you're understanding the intrinsic value of the asset that you're investing in. Of course, that you have a concentrated approach to building the portfolio. Those are really the keys.
I think, as you explain in the book very well, where is the source of the value? Is it intrinsic value or it is statistical undervalue? And the statistical undervalues from a mediocre business will still give you return from time to time based on a special situation, but it is the intrinsic value that will make you wealthy in the long term. You also bring up very well in the book, while talking about Charlie Munger's investment strategies, that you mentioned that Charlie said that Buffett outgrew Graham, but Munger did not. And I guess there was a difference or rather revolution in the way Warren Buffett pursued his investment targets than the most value investors would.
As we were saying before, I think you can be a successful investor in a lot of different asset classes. I remember hearing one of the principals at Tweedy Brown, which is a classic value investing firm in New York, say that you can make money by investing in rags. Literally, if you know how to buy rags below market and then sell them when the market is favorable, you could make a perfectly acceptable living by following the one asset class, which is rags. But I think it's much easier, and I think Charlie Munger's great insight was that he realized that it's much easier to be a successful investor and to employ a concentrated investment approach if you're investing in high quality companies, because you kind of have a tailwind. The companies are growing in value over time, whereas if you're investing in rags, they are not growing in value over time. Maybe there's inflation, and in nominal terms, the price of the rag goes up or something, but a rag is a rag. Whereas if you have a growth company, a company that's a high quality company that's compounding, that the company is in fact getting bigger and bigger over the years, and that's a very important tailwind to have, and it makes your job easier.
Very well said. One of the iconoclasts that you have in the book, as you also name him, Glenn Greenberg. He had very simple and common sense research, but he also had 10 issues in the subtitle. Tell us more about him.
Well, Glenn Greenberg is a very successful investor based in New York, and he fits in very well with the profile of concentrated investors that we have in the book, because he tends to have 10 to 15 securities in his portfolio. Sometimes a little bit less, sometimes a little bit more, I guess. And he doesn't use any leverage. And basically his investing is very, very thoughtful and very conservative, but not conservative with a negative connotation, conservative with a very positive connotation. And another similarity that Glenn Greenberg has to John Maynard Keynes and Buffett and Munger and Lew Simpson is that he tends not to trade very actively at all. His holding period tends to be, measured in years as opposed to months or weeks. And he has a very, very superlative long-term record.
And he very well said that if you are a concentrated investor, you better know what you're investing in very well.
Yeah. And another similarity that Glenn Greenberg has is that he works with a small staff and tends to fit into the profile very closely that way as well.
Yeah, and sometimes you get frustrated by investing in Comcast for long periods of time, as you highlight in the book in his chapter.
Right. There was a period when Glenn Greenberg was invested heavily in Comcast and also in a couple of other cable companies, and had, I think it was about a third of their investment portfolio invested into cable businesses. And he and his staff, studied the cable business very, very closely and knew as much about the cable business, I'm sure, as any of the CEOs of any of the cable companies that they were invested in. And he famously had a had a meal with Warren Buffett and discussed investing in the cable business, and Warren Buffett was not interested in the cable business as an investment because he didn't like the fact that there was a requirement for ongoing capital expenditure to upgrade the systems, and that it was a fairly capital intensive business at the time. And Glenn Greenberg had the presence of mind to realize that he simply understood the business differently and perhaps better at that point in time than Warren Buffett did, and was again had the presence of mind and the temperament not to be kind of scared out of his concentrated position in the industry, and it ended up paying off very handsomely for him. There's another point to make about concentration that we've discussed a little bit, which is that we were saying earlier on that if you have a concentrated investment portfolio, that there will certainly be times when there is some pretty ugly underperformance, and that happened recently in the case of Valiant Pharmaceuticals, and there were some very smart value investors who had large positions, concentrated positions in Valiant Pharmaceuticals, and it ended up being a bust and really hurting the performance of several concentrated managers. And I think the lesson is from that even if you do very, very thorough research, that over the course of a career, people are bound to make mistakes, and that possible to make mistakes and have periods of very bad underperformance and still have a very, very good or better than good, an outstanding long-term record. And that mistakes provide you the opportunity to learn. And one can have a concentrated position in a company that doesn't work out and ends up costing you all sorts of headaches, but you can still be a very successful concentrated investor.
Very well said. You start the book with the chapter 1 focused on Lew Simpson at Geico, and you subtitled that chapter with Disciplined Investor. What was his discipline and how it helped him?
Well, I think one of the characteristics Lew Simpson has, which is really sets him apart from investors, is that he's very good at staying with the fray of Wall Street and in filtering out the information overload and the noise that comes at you from and he's very effective at he's very disciplined about not sitting in front of a Bloomberg terminal all day long and reading the articles as flash in front of you. And he's very disciplined about not looking at price movements every few minutes. That was one of the things that really stood out about Lew Simpson's style. And again, like Glenn Greenberg, like John Maynard Keynes, and all of the other investors in the book, he has a very small staff and a very small office that's very quiet and allows a lot of time for reflection and a lot of time for being important material as opposed to noise.
Is there any insights that you would like to focus on from the successful track record of Warren Buffett? He used that kind of approach that he adopted from some of the successful quantitative investor early on, and then he obviously grew from there. But what is your take on his process and his concentrated investing style?
Well, it seems to me that Warren Buffett was very good at setting himself up with a investment vehicle that provided capital, long-term stable capital, in the insurance businesses. And another characteristic of Warren Buffett that's interesting to note is that he's evolved over the years. And as you pointed out earlier, started off doing more kind of special situations and cigar butt investing that was going on at the Graham Newman firm because the size of Berkshire Hathaway increased. so much, so dramatically, that he had to migrate towards investing in higher quality companies. And these days, Berkshire Hathaway, I would say, has an important portfolio of publicly traded securities, but it's also, I would say, a very, very large and very, very skilled private equity investor in buying whole companies, and as opposed to buying a stake in companies on the stock exchange.
As he likes to sometimes call eating an elephant. But go ahead, yes. Hunting for elephants.
Hunting for elephants, right. Well, no, I think it's being to be able to change what you're doing from starting off investing in small cigar butt situations to hunting for elephants is not flexible.
The migration from the cigar butt, which are the last pups, to the elephants that are just growing monsters. Two last questions. What would be your advice to a retail investor who may not understand or may understand concentrated investing but would not know how to benefit from it? And what would be your recommendation for investment advisors or other investment managers, how they can benefit from concentrated investing?
Well, this book wasn't really written with retail investors, individual investors in mind, because in order to practice concentrated investing, you have to have quite a bit of time at your disposal to be able to understand and know the companies that you're investing in quite well. And, as I said, it's possible, it will certainly happen that people make a mistake over the course of their investing career and have a concentrated position in a company work out. And you're bound to have some period of time when your results look pretty awful. But even with that happening, concentrated investing is the way to produce superior results. But it takes a lot of time. So it wasn't really written the average individual investor who probably is doing other things with their time and doesn't really have the time to devote to it. So it was written more for people in the investment management industry. And the advice for people in the investment management industry, I think, is to really think about what your investment business is all about. And if you're interested in building an asset gathering type of business, then diversification is the way to go. And if you're interested in building a returns-driven business, then kind of tending towards a more concentrated approach is probably the way to go. But you have to then make sure that you have very stable capital, because otherwise there are going to be ugly periods which will be detrimental to the investment management business, although may not be detrimental to your long-term results.
That's right. Thank you very much for your comments on your time. And we have been speaking with Alan C. Benello, the co-author of Concentrated Investing, Strategies of the World's Greatest Concentrated Value Investors. Thank you.
Thank you.